For more, let's welcome in DoubleLine Capital CEO and CIO and founder Jeffrey Gundlach. Welcome back on what's become a tradition, and I'm glad to have you, Jeffrey.
Good to be here, Scott.
Your reaction on what you just heard and what the Fed did?
Well, there's a lot more confusion now than there was a couple of months ago regarding the future path. But the squaring of the two-year Treasury yield and the Fed funds rate is now complete. I talked several months ago about the Fed was behind the curve and needed to get aggressive in getting more in line with the two-year Treasury. But now the two-year Treasury is at 4.35, and the Fed funds rate is at 4 3/8 if you take the middle of the range. So they're exactly there. Underneath the surface, though, there were a couple of problems. The first thing he said at the beginning of his press conference, as always, is they're squarely focused on their dual mandate. And then he used the word cooling for the labor market, and he pointed out that it's looser than it was pre-pandemic. So that seems to be not trending quite the way they might want. And at the same time, he said uncertainty regarding inflation is clearly higher. In fact, I think he let something slip on an ad lib, and I think he said, let's see, he said the forecast from a few months ago on inflation seems to have fallen apart, I think are the words that he used. So what we have now is a neutral rate versus the two-year Treasury, yet the dual mandate that they're squarely focused on is not exactly trending in the perfect direction. The inflation data points have not improved since the September meeting. We follow about 30 different inflation primary inputs, and the number that are showing accelerating inflation in the several quarters ahead have increased since September. Also, what's very interesting about what's happened over what's been really a very aggressive cutting cycle. I mean, they've cut 100 basis points in 3 months, so that's a 400 basis point annual rate. And if you go back over all these Fed hiking cycles or cutting cycles, Fed cutting cycles going back to 1984, so going back 40 years, this is the first time that after the first cut in the Fed funds rate that interest rates have gone up and not down. The 10-year Treasury yield is up by 80 basis points from September 18th, and usually the yield falls on the 10-year Treasury once you go into a Fed hiking cycle. So the takeaway that I got from that press conference was there's not going to be an aggressive cutting cycle as a base case in 2025. Obviously, the market went from 4 implied Fed rate cuts in 2025 to now the Fed's down at 2, and the market is pretty much in sync with that. So much slower rate cuts, and of course, risky assets and a very highly valued stock market doesn't like the idea that rate cuts are less likely on sort of both sides of the mandate. Are in tension with the path that was so comfortably in place per the press conferences in the mid part of this year. That's the confidence just isn't where it used to be. So I think the Fed is now extraordinarily data dependent as we enter 2025. I know they're always data dependent, but at this juncture, it's critical that we watch that unemployment rate, which Fed Powell said that job creation is not high enough to keep the unemployment rate steady. So the base case is that rate's going in the up, which is not the direction they want. And at the same time, some inflationary primary inputs are suggesting that we're not going to get to 2%. I thought the last question that was asked in the press conference was a perfect ending. Kind of, is it good enough to be at 2.5% inflation? Do we have to give up on 2% inflation? Is where we are the best we're going to get? And my takeaway from that press conference is the short answer to that is yes. I think that we're not likely to get to 2% inflation in 2025, and the Fed says so themselves. In fact, we'll probably start having inflationary pressures towards the middle of 2025, and the headline CPI rate will probably not be below 2.5% when the inflation rate starts heading up towards 3%. Now, obviously, all these things can change. We don't have great visibility on the second half of 2025. But unless the price of energy falls, which is possible with drill, being the rhetoric of the incoming Trump administration, we'll see. But oil prices have been remarkably stable. And that's the real wild card is if they would go up for whatever reason, we would start to see significant inflation risk, and there would be no Fed cuts in 2025 if that's the case.